Commission's 2026 annual report cycle. Thank you for joining us. We welcome our witnesses and are grateful they're here to share their perspectives. I'd like to extend our appreciation to the Senate Commerce Committee for the use of their hearing room, as well as the Senate Recording Studio for their assistance in live streaming this event. For those attending in person or watching online, witness testimony is available on the Commission's website, and a transcript of this hearing will become available. Today's hearing will examine China's role in key commodities markets. For over 2 decades, China has quietly pursued the development of domestic futures exchanges, expanded their production of processing of core commodities, and became a key market maker in many segments and sectors. These actions are in furtherance of their ambitions to one day challenge existing global financial exchanges. China's 15th five-year plan signals that it will step up its efforts to develop futures and derivatives markets, along with a whole host of enhancements to optimize the prediction, trading, and utilization of key commodities. In 2025, China imposed stringent export controls on critical minerals and rare earths, focusing the world's attention on the fragility of supply chains for critical inputs and sparking discussion in the United States and around the world on building alternative supply. China is the world's largest buyer of numerous commodities, from crude oil to soybeans. It dominates processing and refining in many industries, producing inputs for its industrial sector. As we've seen over and over, access to factors of production is a national security issue, and that often runs through commodities markets. In many markets, Chinese firms are the primary purchaser of goods, and Chinese processors are the primary manufacturer. China has also demonstrated its capacity and will to cut off supply and require onerous disclosures. Taken together, these dynamics have the potential to present significant future risk to global commodities markets, safety, and soundness. Prices in physical markets are influenced by supply and demand, but the financial markets for these commodities runs deeper than the physical markets. Benchmark prices are set on the New York Mercantile Exchange, CME, or the London Metals Exchange, in addition to numerous other regional exchanges around the world. Traders on these exchanges are not just physical buyers and sellers hedging price exposure. They are international investment banks, hedge funds, individual investors, and large commodities traders, which with benchmarks set in the US dollar on international exchanges under the purview of US, UK, or European regulators, China has been at a major disadvantage when it comes to pricing power for agricultural goods, base and precious metals, and energy products. China recognizes this weakness and has made enhancing its pricing power an explicit goal in developing domestic exchanges. The volume of futures trading has grown rapidly on Chinese exchanges, which now count themselves among the largest in the world. Hong Kong exchanges and clearing acquired the London Metals Exchange, one of the 3 most important exchanges in the world, in 2012. China has also already begun to direct its state-owned traders and buyers to use Chinese pricing indices. In 2020, Chinese exchanges accounted for 79% of all agricultural futures and options contracts traded, and in 2023, the top 10 contracts were all traded on Chinese exchanges. Iron ore traded on the Dalian Commodity Exchange is the world's deepest market in terms of volume. The Guangzhou Futures Exchange has created the world's first futures contract for lithium, while competing CME contract is more lightly traded. China is also starting to show its future playbook. And in autumn 2025, the big 3 iron ore miners were pushed to switch contract prices away from S&P's Platts price index in favor of a new index preferred by China. While only moderately successful, this demonstrates future ambitions and potential to sway contracts to preferred market facilitators. Despite the large volumes on several Chinese exchanges, large institutional investors remain wary because the same standards and accountability that exist in US markets don't yet exist on Chinese exchanges. But complacency and short-term thinking yields risk. We should plan for a future where these exchanges can credibly compete with US exchanges. This hearing will look not just at the current status quo, but also look ahead to understand what success for China is in this sphere and what that would mean for global commodities trade, supply chains, and manufacturing. I would like to thank my fellow commissioners for their participation, our witnesses for their testimony, and the staff for their support in organizing this hearing. I will now turn the floor over to my colleague and co-chair, Commissioner Taylor Bedowich.
Thank you. Thank you, Commissioner Schmobonian. And thank you to our witnesses for what you've prepared today and for being here. U.S. preeminence in global financial markets was built over centuries, from the founding of the Chicago Mercantile Exchange in the 19th century to today's U.S. dollar-linked stablecoins. The United States has always been at the cutting edge of financial innovation. Deep liquid markets reduce volatility. They let buyers and sellers agree on a fair price, not one dictated by the government of a non-market economy. Investors come to the United States because they trust the rule of law, smart regulations, and fair competition. The United States has opened its markets to the world. China has not returned the favor. U.S. financial players remain walled off from Chinese markets, while Chinese capital moves freely through ours. The asymmetry is beginning to shift, but on Beijing's terms. At the start of 2020, only 6 Chinese futures contracts were accessible to foreign investors. Today, there are around 100. China is accelerating its effort to bring global futures trading, and with it, the ability to set global prices to China. What would shift in pricing power to China mean for the United States? 3 things. First, market manipulation. An RMB benchmark set in Shanghai could reflect CCP interventions designed to advantage Chinese companies. Directives to state-owned traders, contract terms structured to favor Chinese producers, and price interventions that serve political rather than market objectives. Second, currency risk. Contracts priced in the yuan are exposed to China's currency policy, including deliberate devaluation when it serves Beijing's interests. Third, sanctions evasion. The yuan-denominated commodity system would let Chinese traders and their partners conduct global transactions entirely beyond the reach of U.S. financial tools, undermining one of the most important instruments of American statecraft. The Commission prides itself on identifying threats and advising Congress on risks before it's too late to respond. U.S. futures exchanges still play a dominant role in price discovery for the commodities that matter most. But China is ramping up its effort to change that, and the direction of travel is clear. Our witnesses today will offer different perspectives on how far China has come, how serious the threat is, and how the United States should respond. I look forward to your testimonies. Thank you.
Great, thank you. Our first panel will provide an overview of China's efforts to enhance global pricing power by expanding its commodities futures exchanges and explore how the internationalization of China's commodity derivatives market ties to its broader aims for RMB internationalization. We'll start with Dr. Johannes Petry, senior researcher at the Goethe Institute, Frankfurt. Dr. Petry's testimony will discuss China's strategy to internationalize its futures markets and examine the consequences of existing price benchmarks. We'll then hear from Mr. Martin Chorzempa, senior fellow at the Peterson Institute for International Economics. Mr. Chorzempa will evaluate China's incremental efforts to accelerate RMB internationalization through digital currencies and the potential impact on RMB-denominated trade. Thank you very much for your testimony. The Commission is looking forward to your remarks. I ask that witnesses keep their remarks to 7 minutes. Dr. Petry, we'll begin with you.
Dear Commissioners, thank you for the opportunity to testify today. China's efforts to develop commodity futures markets and enhance its influence over commodity pricing are best understood as part of a broader strategy to reduce financial vulnerabilities and increase strategic autonomy. Commodity pricing power in this context is not simply about market efficiency or improving price discovery. It is about the ability to shape the financial infrastructures through which commodity prices are formed. Current global commodity pricing was historically embedded in a US-centered financial system. Benchmark prices for oil, metals, and agricultural products were predominantly determined through futures exchanges located in the United States and its allies. These benchmarks are sustained not just by physical supply and demand, but by an ecosystem of financial institutions, regulatory frameworks, and dollar-based infrastructures. As a result, pricing power is not easily shifted by increasing physical market share alone. Instead, it depends on institutional credibility, liquidity, and network effects of the commodity futures markets that underpin benchmark formation. China's efforts to increase pricing power must be understood in this context, and its strategy has evolved significantly over the past 2 decades. Initially, the focus was on developing domestic commodity futures markets to support internal price discovery, manage volatility, and serve broader industrial policy goals. In this phase, China's futures exchanges in Shanghai, Dalian, and Zhengzhou were primarily geared towards domestic actors and operated within a regulatory framework that emphasized stability and state oversight. More recently, however, China has moved towards selectively internationalizing its commodity markets. This includes expanding foreign investor access, introducing internationally accessible contracts in key commodities such as crude oil or iron ore, and developing delivery and settlement infrastructures that link domestic markets more closely to global trading networks. At the same time, China has sought to promote the use of renminbi-denominated contracts as part of its broader efforts to internationalize its currency. This strategy is underpinned by China's position as the world's largest importer of many commodities and its growing role in processing, refining, and extracting key materials. By aligning its financial market development with its physical dominance in these sectors, China is incrementally increasing the relevance of its pricing infrastructure and mechanisms within global markets, especially with its partners in the Global South. Despite these advances, China's influence over globally recognized benchmark prices remains limited. While Chinese futures contracts are widely used domestically and are becoming more relevant regionally and in specific sectors, they have not achieved the levels of international adoption necessary to rival established benchmarks yet. The key constraints include restrictions on capital flows, continued regulatory intervention, limitations on participation in these markets, and broader concerns about transparency and governance. These constraints reflect a deeper tension in China's approach. Efforts to internationalize its markets are pursued alongside a continued commitment to maintaining state control over financial activity. This model has proven effective in supporting domestic stability and industrial development. However, it also limits the extent to which Chinese markets can serve as globally trusted mechanisms for price discovery. Benchmark status ultimately depends on sustained participation by a wide range of global actors, including commodity trading firms, financial institutions, and non-financial companies that hedge their physical risk in these markets, as well as confidence that prices are formed in a transparent and rule-based environment. Looking ahead, a likely outcome of China's quest for pricing power is not a replacement of existing global benchmarks, but rather the emergence of a more fragmented pricing system. In such a system, Chinese benchmarks will play a growing role alongside established ones, particularly in sectors where China holds a dominant position in physical supply chains, such as metals and critical minerals. In other sectors, like global oil markets, existing benchmarks are likely to remain dominant. This implies a future in which pricing power is more distributed and increasingly contested across regions and commodity sectors. Maintaining US leadership therefore requires first reinforcing the foundations of the existing system. This means sustaining the credibility, openness, and liquidity of US financial markets, which remain the cornerstone of global commodity pricing. Ensuring that producers, traders, and financial actors continue to rely on US benchmarks should be a key priority. Second, the United States must actively support the global role of the dollar. The dominance of dollar-denominated pricing is not guaranteed and depends on the continued availability and trust in deep and liquid dollar markets. Expanding access to dollar liquidity, particularly in times of stress, through instruments such as central bank swap lines and related facilities, will be critical. At the same time, policymakers should be mindful that the extensive use of financial sanctions or undermining central bank independence can create incentives for other countries to diversify away from the dollar-based system. Third, US policy should place greater emphasis on engaging third countries, particularly in the Global South. The diffusion of pricing power depends on whether producers and consumers choose to adopt specific benchmarks. Supporting these actors in accessing and using US derivative markets can help sustain the global relevance of existing benchmarks. Finally, there is a need for a more systematic monitoring of the evolving pricing landscape. The adoption of benchmarks, the currency denomination of contracts, and the participation of key market actors are often difficult to observe, particularly in physical markets. Establishing a dedicated mechanism to track these developments would significantly improve the ability of policymakers to respond to emerging shifts in global pricing structures. The most effective response for the United States is therefore not to replicate China's model, but to reinforce the institutional strengths that have historically underpinned its leadership in the global financial and commodity pricing system. Thank you, and I look forward to your questions.
Thank you. Mr. Chorzempa.
Thank you, co-chairs and commissioners. It's an honor to be here today. My remarks are going to focus on broader renminbi internationalization and how it interacts with the main focus of the hearing. And the core connection is the following, that renminbi internationalization and these commodities derivatives markets in renminbi are mutually reinforcing. So the way to think about this is if renminbi use overall is low, then liquidity is low. It is expensive to go in and out of renminbi. Hedging instruments to hedge the risks of currency movements become more expensive, and there's also limited ways to invest the proceeds if you're holding renminbi that you need to pay later on. This friction discourages participation in any Chinese markets. But conversely, if these markets that are the subject of today's hearing become quite successful, that could be a kind of killer app that pulls people in to use the renminbi and gets started with this chicken and egg problem. You actually then start to get the liquidity, there's demand for hedging instruments, then supply comes in, and that becomes a positive reinforcement. So that's the core dynamic to watch. What we see so far is that the renminbi use is still actually quite limited despite China's goals. China's leaders have increased their ambition in renminbi internationalization recently. So Xi Jinping recently said China needs to be a strong financial country, have a strong currency, and and for the first time affirmed that China needed to have a global reserve currency. This has not been part of China's goals in the past. And one of the reasons for that is, of course, as Johannes mentioned, autonomy. China's central bank governor has said that there's a tendency to weaponize a dominant currency that then weaponization of dominant currency that is related to the sanctions risk. China has engaged in a multifaceted campaign to try and expand the use of the renminbi. It has built an infrastructure called the Cross-Border Interbank Payment System. It's engaged in CBDC innovation and signed swap lines, and also ordered banks to use more renminbi. So what have the results of those so far been? Actually quite limited, considering China's overall economic weight. China is the world's largest trading nation. About 14.6% of global trade involves China, but China's share of global foreign exchange trading is actually much lower. It's 8.5%. That has increased substantially from 2% in 2013, but the US in this period has gone from 87 to 89. So all of China's gains have come at the expense of other secondary currencies. It has not eroded the core role of the US dollar in the international system. If we look at interest rate derivatives, which would be crucial in these kind of markets, renminbi is only 1% and actually has lower volume than the Swedish kroner or the South African rand. It really does not suggest that China is really becoming a key hub for this kind of trading. If we look at SWIFT payments, which is the best data that we have on globally which currencies are being used in payments, we see that China had major gains after Russia's invasion of Ukraine, up to 4.7% of global trade, and everybody focuses on that, and then they ignore that actually in the last year and a half, those numbers have actually come back down, and China is now the 6th most used currency after the Canadian dollar, which is kind of quite incredible that it would have less volume than so much smaller economy. One interesting point about the SWIFT data that illustrates a broader point. There's a divergence between the data on China's own payment systems and the SWIFT data. So the CIPS data, which is China's own infrastructure, has stagnated for the last year and a half, and the SWIFT numbers are come down. That is an indication, most likely, that China has attracted more banks internationally to become direct participants of the CIPS system, and then they don't need to use both CIPS and SWIFT. And therefore, it's only counted in CIPS. It also means that sanctions that touch on SWIFT would have less of an impact on China. So watching direct participation in the CIPS system is one of the important factors to watch. Then a lot of people talk about the digital currency space and mBridge in particular, which is a multilateral central bank digital currency system. It was originally at the Bank for International Settlements as a international system, and now it has been taken over by China, and they recently added Saudi Arabia to this. We only have one public data point on the volume in the system. It is 4,000 transactions in its total history as of November last year, and 387 billion renminbi that's been transacted. 95% of those transactions were in renminbi. That 95% figure sounds positive for the renminbi, but it's actually a negative because it means that the other participants in the system are not using it to trade amongst each other, that almost all the transactions are just between those other countries and China. And one interesting data point, there were all these Reuters headlines about how amazing the volumes are in this system. The US system called CHIPS, which handles most US dollar payments, handles a higher volume of transactions between 9 a.m. and 9:04 a.m. than the entirety of the history of the mBridge system at this point. So it is just simply not yet playing a role in the internationalization of the renminbi. However, we shouldn't dismiss this system because we don't know when exactly China started operating it. It could have been operating it, only for a month before November, and then those numbers would show that maybe the data it's ramping up much more quickly than we expected. So, but I'll conclude looking at stablecoins. So, middle of last year, the U.S. passed the Genius Act. Stablecoin volume was growing substantially, and it looked like China was going to face a serious strategic challenge because it was all in on central bank digital currency and doing nothing on stablecoins. It was at that point considering expanding a pilot program in Hong Kong that would allow Chinese fintech companies in particular to issue stablecoins. That has since been shut down, and China has decided not to move forward except with a few traditional financial institutions, and they've scaled back that massively. So far, they're not regretting that decision because the stablecoin market has frozen. It's not grown at all since late last year. So I'll conclude with what to watch for. Renminbi internationalization indicators. There is no stable equilibrium here. If some of these numbers start to go up, then the others could rise with it. So that's something to really keep an eye on in real time. Pay attention to whether China opens its capital account, and pay attention to mBridge transaction volumes if we see any more data on that. Thank you.
Great, thank you, much appreciated. I'm going to exercise chair's prerogative with the first questions. This question is for both of you. You both touched on this in your testimony, but can we drill down a little more on why China views commodity pricing power as a component of of geopolitical competition, and why that is important to China more broadly? Not a meaty question at all. Dr. Petry, we can start with you.
Yes, thank you for that question. So I think a key experience that one needs to keep in mind is where China was 20 years ago. Right? This was there was one event which really shaped how Chinese regulators thought about and authorities thought about pricing power, which was the so-called Battle of the Beans in 2004, where essentially China and Brazil wanted to conduct soybean trading, bypassing Western agricultural multinationals like Cargill and ADM. And what happened in that process was they tried to hedge the risk on the Chicago Board of Trade in trading a soybean contract, but essentially they completely overpaid, and due to market volatility at the time, It essentially led to a lot of these soybean crushers in China to become bankrupt. They were essentially bought up by these exactly these firms that they wanted to avoid in the first place. And this was really, this kickstarted debates in China about kind of new imperialism and vulnerability in the financial system that needed to be addressed. In 2008-9, with the kind of global financial crisis, and also where we saw a lot of volatility in global food prices. This kind of strengthened this debate in China that they need to have a say in kind of commodity pricing more generally, especially as China at the time had become the largest importer of a lot of these commodities and really had to rely on prices that were made elsewhere. So this kind of kickstarted the creation of futures markets in China that had been shut down in the 1990s, essentially.
So I'll link it to a bigger issue, which is that countries around the world are concerned about the spillovers that they face when, because of the reliance on the US dollar system and commodities that are priced in the USD. So it's not just a China issue. You know, when the Fed changes its monetary policy, that can make it, for example, more difficult for countries to get access to dollars, more expensive for them to get access to dollars, and constrains what they can do. And if all of their commodities are priced in US dollars, that can create a challenge for them. China shares these concerns, but it also has the additional concern that it thinks it might be targeted with sanctions in the future, and therefore they want to be able to continue to, buy and sell key commodities, whether they can get access to dollars or not. And if they're shut off from access to dollars and can't access the main way these are traded, that's a big problem. We've seen this with Russia, for example, when it's not able to get access to dollars. Even when trading with China, it's had to go to this kind of barter system to trade that has made it much more cumbersome for them to handle even basic payments, and China doesn't want to be in that position in the future.
Great, thank you. What level of confidence do we have in the data that's coming out of China with respect to some of these benchmarks and systems that we are basing research and analysis on?
So I think, the data is really very patchy, right? The trading volumes of the exchanges, I think that is fairly transparent, but what we don't have is whether these prices are actually adopted in physical commodity transactions between, kind of, let's say, a buyer and seller of copper, for instance, right? So actually, we don't know which benchmark or which reference price they use for these contracts. So it's quite difficult to assess the actual pricing power.
Yeah, I deal with this question all the time myself. It is generally, I think, quite reliable, these data. China does not have an incentive to tell the world that its SIP system is stagnating and not growing at all. So I look at the incentive and the data, and is it diverging? And then, the Enbridge data, the only data point we have is one article by the vice governor of the PBOC, who's trying to say that this is a great thing, that these numbers are so large. But again, they seem actually quite small. So I feel pretty confident in these sets of indicators. In general, financial market indicators are a better marker of activity than something that just is calculated by Chinese statistical authorities, which might be more likely to be manipulated. Of course, the markets can be manipulated too, though.
So just to drill down on that point, and then we'll turn it over to my co-chair, if the SIP system could be indicative of not just transactions within China, but also sanctions evasion, it would seem that there actually could be an incentive to hold those numbers steady so that we don't have insights into how alternative financial flows are going to China. Is that an appropriate read?
It's possible, and interestingly, just last month, the numbers in SIPs, after a year and a half of not moving, just rocketed up. So that might be a sign that that these toll booth payments to Iran for use of the Strait of Hormuz or something like that can be over RMB. So interestingly, we actually do see that spike which would gather attention right there.
Thank you.
Thank you both. This has been great. We've talked about a little bit the lack or unclear data that's coming out of China. One of the things that I found interesting that Mr. Petry, you've done over almost 300 interviews in markets there. Can you first help me understand the context of those interviews and kind of the methodology behind it?
Sure, yes. I mean, this was for a larger book project on capital markets with Chinese characteristics, as the title, and really tries to understand how financial markets in China are organized differently than, let's say, in the US, understanding the role of the state, basically, in organizing these markets. So the interviews were with exchanges, investors, brokers, hedge funds, and all the different market actors in China, commodity trading firms, trying to get good coverage of all the exchanges and most important actor groups.
And so the point of that question is that I wonder, it looks like you've done a couple dozen more interviews just recently. Was there anything different that was being said in the last couple weeks when you did that versus last year when you did? And can you talk through that?
Yes, I think a key point was that there is a few things are happening in China at the moment. So I was just made aware of that on Monday, actually. The Shanghai government now has a kind of an action plan to link physical infrastructure for commodity trading with the futures markets. So extending warehousing facilities and settlement for RMB and so on. So these are some of the things that are happening. There's a lot of excitement about the new contracts that are being opened up. They seem to have a larger role in pricing increasingly, especially over the last years. Things have shifted here. So there's definitely a lot happening, and people are, yes, so there seems to be more movement in that area.
Thank you. Mr. Chorzempa, you talk a lot about, or you've made some arguments about sanctions and the fixed costs associated with them. What is the right balance? Because the United States has enjoyed its influence and use of these sanctions. How can we continue to utilize them in a responsible way?
It's an excellent question. Overall, I think we have to recognize that anytime you use a piece of choke point leverage, that creates a kind of antibody-like counter response. So in general, the way that we use sanctions on Russia, for example, and the aftermath of its invasion of Ukraine was, I think, quite a positive example of doing that, in particular because that was global. So every single other reserve currency issuer, including the Swiss, actually imposed sanctions as well. And that means somebody who wants to avoid sanctions can't just leave the US dollar and go somewhere else. That is a crucial part. When we use sanctions unilaterally, I think it's less effective. Also, when we use sanctions in kind of a halfway, they're not very effective. So an example of that would be when there was this push to de-SWIFT Russian banks, but not actually put them on the sanctions list. All that did was kind of politicize the infrastructure layer and make it a little more annoying for them to handle payments, but they could still legally handle those payments with China or anyone else. It should be instead either put them on the sanctions list or don't put them on the sanctions list, but don't really focus on the middle element. And then I would say we should look at the record of using sanctions for human rights issues, for example. I think a lot of time there's a reflex to use sanctions when we're frustrated about something and maybe put people on the list in China. And I don't think it necessarily actually changes behavior. So I think we should look at really where can we actually make a strong impact with them so they don't look weak, because if we put sanctions on that don't work, that weakens the potential deterrent effect.
Thank you. And you touched on this a little bit at the end of your testimony, so if there's anything you want to add, that's great. But I'll pose it to you as we talk about benchmarks. What are some benchmarks that we should look at? Because the picture you've painted is far from being an alarmist on this topic. And so what would give alarm as we see movement? Is it regionally? Is it on certain specific commodities? What would give you alarm? Again, I know you've touched on this a little bit, and I'll pose the same question to you, Mr. Petry.
I would look at the share of China's trade that is in renminbi as one. The other would be the SIPS volumes. If this spike that happened last month continues and continues to rise, that would be a sign that they're starting to get serious volume. And then also watch the derivatives markets in terms of currency risk and interest rate risk, because if those start to get very liquid, wide availability, it will be much easier to get into the renminbi. And finally would be global investor interest in investing in China, because that actually declined a bit after US-China tensions last year were large, but then there was a kind of resurgence of interest in China. If there are a lot of people want to invest in China, that creates that demand.
Yes, I wanted to second that point as well. The participation of global trading firms, investment banks, etc., in Chinese commodity futures markets is essential for gaining more pricing power. So that is something that needs to be kind of focused on, in how far these markets really internationalizing, and are they then used for kind of benchmarks? You mentioned the example of the iron ore producers having to adopt RMB-nominated benchmarks. I think these are some of the key factors that one should look at.
Thank you both.
Commissioner Brands.
Thank you. Maybe I could just pick up on your toll booth comment. And so I'm curious to hear from either or both of you. We've had some pretty significant global economic volatility in the last 2 years. So whether it's trade frictions in 2025 and after, or the frictions associated with the conflict in the Middle East, how, if at all, have those frictions affected A, Chinese thinking about the importance or the role of pricing power, and B, the prospects of getting there?
Sure. One of the most important elements of volatility that have affected this is the decline in the U.S. dollar after April of last year. Many international investors who put money in the U.S. but have report their earnings elsewhere were burned quite substantially by this, and it actually became significantly more expensive to hedge U.S. dollar exposure if you're, say, a European or a Southeast Asian investor. And that, of course, reduces interest in the U.S. It makes it more expensive to invest in the U.S. Then, of course, that money can go elsewhere, potentially including China. So, and then also concerns about the U.S. fiscal situation with the expanding deficit, and also some challenges in the treasury market that, the hope was that stablecoins would fix that and create all this new demand for treasuries. We're not necessarily seeing that. So the more stable and attractive our markets are, the less room there is for China to step in and get this international interest. But over the last year, I think there's been more interest. And also just generally China's technological innovation has led there to be more international interest in going into Chinese AI companies, for example, or chip companies or robotics companies. A lot of people have made a lot of money investing in those areas in the last year. That's something to watch.
I think what also matters here is that China had for a long time had this idea of gaining pricing power in commodities, and has been building the financial infrastructures to enable that eventually. So putting in all the railways that it needs, like the SIP system, etc. And what we saw in the last couple of years was especially that other countries started rethinking, right? We had all these debates about de-dollarization around the world. And so I think this is something that really changed as well, that other countries are also thinking about, okay, should we do something in RMB? Right, there's this one example where just recently, I think it was in October last year, copper miners in Zambia can now pay their taxes in RMB. Right, these are Chinese copper miners. It's a small country, but still, it's these kind of things that we see more and more often happening, that other countries think differently about the dollar and China.
And Dr. Petry, you talked a little bit about in your testimony and your written statement the need to engage third parties to shore up the foundations of the existing U.S.-led system. Could you just talk a little bit more about what that looks like and what steps you think would be particularly important?
Yes, I think one issue might be to actually incentivize these actors to trade on kind of U.S. Commodity markets. I mean, it's quite difficult for some countries to do that still, right? I mean, there's very few. I mean, I think even if you were to allow the Chinese brokers to trade on these markets, I think there's one FCM at the moment in Chicago. I mean, there's more than 100 Chinese commodity brokers, right? So this would at least, they would play in your backyard, basically, instead of in China. So I think, yeah, generally allowing other countries easing access to US markets.
Thank you very much.
Commissioner Hodges?
Hi, thank you. Building off of Commissioner Shmovonian's question earlier, I want to talk a little bit more about sort of goals and ambitions. Since sort of 2008, the timeframe you referenced, can you give us a clear assessment of how much they've gained in capabilities today? Have they reached those goals and ambitions? Are they still making progress toward that in sort of clear terms for both of you?
So I think what we see is that the markets in China have developed quite substantially in that period. In the early 2000s, commodity markets really didn't exist to a large degree in China. And since then, they listed more than 100 contracts, which are now open to international investors, either through the QFII channel, which is a bit more cumbersome, but increasingly also by internationalizing them, making it a lot more attractive to invest in them for international investors. So I do think we see quite a lot of the kind of supply from the Chinese side being provided. The question is now whether others might accept these prices. So it's really a question of demand now and how third parties react towards China's increasing opening. But the markets are definitely way more open than they were a few years ago.
Thank you.
One way to think about the progress they've made is kind of as an insurance policy. So up until, if we look back at 2008, many currencies literally could not be traded directly between the renminbi and them. They would have to go through the US dollar. Now there's a lot more ability for China to trade directly. There are banks throughout Southeast Asia and Central Asia and elsewhere which have been authorized to trade, to trade renminbi directly between those currencies. You have the SIPS system, which did not exist. You have Mbridge, which did not exist. The swap lines has expanded. So there's a large variety of this kind of basic infrastructure, but the fundamental problem is back to this chicken and egg problem. If they're not used very much, they're very expensive, they're clunky, and so if no one uses them, then no one wants to use them, no one wants to use them, no one uses them. But the point is that if there were a situation, for example, some conflict over Taiwan in which major financial institutions are put on the sanctions list, these are kind of existing pipes that could be expanded and activated in major ways if the main way of transacting through the US dollar is no longer available to them.
Thank you. And Mr. Petry, you've previously talked about how China uses commodity futures exchanges as instruments of structural financial power. What sort of policy architecture should we be considering as we're looking at addressing and remedying some of the Chinese tools used to suppress competition?
Yes, I think the main mechanism would be to really strengthen the commodity markets in the US, ensure that others use these benchmarks as well. So, because China will continue to open up, I think. I mean, and so it's really about third parties, whether they choose to use these Chinese benchmarks or US benchmarks. So engaging with countries from the Global South that are major commodity providers that might have dealings with China to trade in US markets, use US benchmarks instead of using Chinese ones.
And just to drill down on that a little bit further, because since you raised the third parties, this isn't just working country to country, this is also working with international companies and such, correct? Yes.
Yes, indeed.
Okay. Thank you.
Commissioner Miller.
Thank you. Dr. Petry, I'd like to pull on a thread that you were discussing in your testimony, which is the implications for housing commodities exchanges and pricing commodities in an economy with a closed capital account. In my day job, I spent a lot of time tracking the flow of capital around the economy, and we have a term for that called the money ball. The money ball bounces based on what the average citizen assumes is going to be the government preference of the day, of the month, of the year, and the money ball bounces from equities to bonds to property and also to commodities and commodities futures. So you have a very interesting dynamic in this closed-to-capital account where there's high level of retail speculation. And of course, if you look at the data, it does show that there's a fairly low ratio of open interest to volume, which suggests that there's a very high level of retail speculation, at least compared to the United States, versus commercial hedgers. What are the actual implications of this? Is this something that we should be worried about? Is this something that Beijing's worried about? How does the closed capital account feature of this change the dynamic of what we're talking about?
Yes, that's a great question. Beijing is definitely worried about the retail investors in its markets and has been for quite some time. And there have been quite a few efforts to try to make these markets more professional, more sophisticated. There has been a lot of efforts to educate investors. So what we saw over the last decade was the share of retail investors actually decreased quite significantly. They're still very active, but their share has increased over time, both in the stock market and in a lot of the different commodity futures contracts. And part of the opening process of these markets is to get international investors into the market to kind of as a counterbalance as well against retail investment in China. So that's definitely something that we have seen. What we also saw was a lot of training or kind of programs by the exchanges, by the Chinese exchanges, trying to get commercial hedgers to use these markets more regularly. That seems to have picked up as well. So from Beijing's side, they're actively working towards making these markets more mature. They're still not where they would like to be, but I think they are kind of on that path.
Sure. I agree with Johannes. One of the challenges that China's had is trying to move away from these retail-driven, especially in the equity market, where people just, as you say, pile in when the state council starts talking really positively about stocks. And the fundamental challenge here, as I'm sure you know, is that China wants to have all the positives of these markets with none of the volatility and the negative side. And that means that you don't actually get many of the positive elements of having true market pricing because, on the way up in 2015, for example, they love that the equity markets are rocketing up. And then when they start to go down and you find that, margins are getting unwound and it threatens potentially the financial stability, then they call in the national team and put a floor on the prices, which means that you don't properly price anything anymore. You don't properly price the downside risk. And I see this across markets for interest rates, for credit. They want the market, but they don't really want the full package, and that's not really how it works. So then you muddle through and get something that doesn't really function as efficiently as it should.
Thank you. So let me flip the first question over and talk about it from the other direction. The renminbi is soft pegged to the US dollar. So there's a lot of concern on this side of the Pacific, certainly, about commodities pricing being done more in yuan than in dollars. But what are the actual implications of that if the currency is soft pegged to the dollar anyway?
So I think the most important implication is, as Martin already mentioned, that it does give Beijing the ability to evade sanctions potentially. And for kind of Chinese consumers, or kind of commodity trading companies, etc., or buyers of commodities, this might, there wouldn't be an FX transaction risk. They would kind of maybe, I think it's between 1% and 3% cost saving that they could have by using RMB contracts instead of dollar contracts, because they wouldn't have to do any hedging and so on. So that is probably the two most important aspects of it, I would say.
Yeah, I think the other element is that, even though it is soft pegged, as you say, the renminbi does move against the dollar in potentially significant ways. That then changes. And in the last, if I recall correctly, in the last when the dollar depreciated, they kind of let the renminbi appreciate. So that then leans against some of the other pressures. So they do get some autonomy from U.S. Financial conditions because of the fact that the renminbi is sort of guided up and down. It's not really a free market, definitely, but it is not fully coupled to the U.S. dollar.
Thank you both.
Commissioner Price.
Thank you, and thank you both for being here today. I want to focus particularly on some of your recommendations. My colleagues have asked similar questions, but that won't stop me from re-asking. Is there, first of all, just as an overview, is there any reason to believe that the U.S. and our allies are not paying enough attention to this issue?
It's possible. I think the main thing is, I think there's generally a sense that insufficient urgency to improving our own systems maybe here. The U.S. is often late to adopt new international standards, for example, in the payments side. And if we look at what the Europeans and the British are doing, for example, they're building out new ways of doing payments, potentially with wholesale central bank digital currencies. And we're kind of doing a completely different approach with stablecoins that might not necessarily interact as well as we might hope. And meanwhile, one of the things I mentioned in my recommendations is that kind of it's not generally recognized, but the correspondent banking system has been shrinking quite substantially. And what this means is that somebody who is in an emerging market economy or a developing market economy, to get from their bank to a bank that has direct access to the US dollar infrastructure, they have to go through more hoops, more steps. And each of those steps adds a delay to the payment, it adds a cost to the payment, it adds a risk that the payment's just gonna get held up and have some data problem that somebody needs more information to make that clear. And for every delayed payment in the dollar is a potential that someone is interested in moving towards an alternative system. And we've kind of slept on it because our payment system at home works really well for most consumers and everything's really liquid, but we really need to keep innovating and not giving China the space to get ahead of us.
I think the point on correspondent banking is very important, because what we also saw was that kind of Chinese banks are internationalizing themselves right now, right? So in a lot of countries in Africa, they will have a presence, but US correspondent banks might not have one, right? So, and then they're more incentivized to do bilateral trade with China in RMB. Especially because these are the commodity producers for a lot of the contracts that are then being traded either in China or in Chicago, for instance. So I think this is something, more attention needs to be paid to these countries in the Global South. Because I think this has been, probably has been lacking recently.
Thank you. And you specifically talked about engaging third-party countries. Commissioner Brand asked you the first question on that. Can you specifically focus not just on the Global South, but in general, but Latin America, and what might need to happen there?
Yes. So one option could be to include central banks in Latin America into the Fed swap line system to offer them dollar liquidity in times of crisis. That could be kind of one option. That's and also, or maybe kind of the FEMA repo facility access for these commodity producing countries, expanding that. Maybe leveraging EXIM or DFC to more actively finance commodity production in these countries, and or kind of infrastructure projects linked to kind of commodity production, maybe then conditioning kind of this support on the use of certain benchmarks
Thank
in
you.
the US.
Thank you. Mr. Chorzempa, you talked a bit about overreach and sanctions, and Commissioner Budovic remarked on that also. Can you talk a little bit about what overreach looks like?
I think that the overreach is when we engage in significant unilateral sanctions that the rest of the global community, including our allies, are not interested in doing. That creates a perception that we are, weaponizing the dollar. So maybe one example could be on the International Criminal Court, depending on your point of view on that, because that's an organization that is controversial, but is that a good use of U.S. sanctions authority? I think this administration's actually been pretty careful about sanctions, in part because of concerns around the in general, because of concerns about undermining the role of the US dollar. But we have to be careful that we don't go too far and just become averse to using them at all, because then, again, they lose their deterrent power.
Thank you. I have one more, but I'll do it if we have time at the end. Okay.
Thank you. Commissioner Shriver.
Thank you, Madam Chair, and thank you to our witnesses. Really appreciate your statements and learning opportunity for me. This has really been interesting. Dr. Petry, you mentioned that commodity markets might become more fragmented and pricing might become more contentious. Pulling the thread on that, using your best crystal ball, how do you see this playing out in 10, 15 years?
Interesting question, thank you. I think what we will see is that the two countries are currently pursuing very different paths when it comes to energy policy. The US is kind of more doubling down on fossil fuels, whereas China is really doubling down on green energy, green transition technologies. So, for instance, I would not see WTI or Brent, which is very much influenced by WTI by now, I would see them remaining the main oil benchmarks globally, also because the US is the largest producer and exporter of oil globally. Whereas China has a much stronger role when it comes to, let's say, materials for batteries or kind of EV production, photovoltaic, and so on. So let's say in lithium, for instance, or nickel, we might see China or copper having a much stronger kind of role in pricing in a few years.
Thank you. Mr. Chorzempa, same question for you, but with respect to RMB internationalization.
Good question. I suspect China's renminbi internationalization will continue to rise. So if we look at the share of China's trade in renminbi, currently 28%, that will probably continue to increase. I think over time they'll increase the financial volumes in many of these many areas of trading, including, it's kind of curious to me why they haven't developed these hedging markets and created liquidity. I mean, they have the biggest banks in the world. They can order them to do these things, but they haven't really taken those steps so far, largely because they've been more concerned about domestic stability than opening up and a bigger international role. I think it will also depend on the extent to which we use sanctions. If we start to ramp up use of sanctions again, then they'll ramp these up. One thing to think about in terms of whether they actually really take over from the US, I suspect that the CBDC system is not going to work as well as they hope, that Enbridge is going to have trouble expanding its volumes in a major way, but also that the US might not find that stablecoins are as good at internationalizing the dollar as we might hope, have some drawbacks. What we might see instead is a kind of blending of those two systems where there are CBDC infrastructures and stablecoin infrastructures, and they're able to interact amongst each other, and people use stablecoins, but kind of in the background as just like a settlement thing. And when you're actually sending an international payment, you don't actually touch the stablecoin itself. The person you're sending money to doesn't touch the stablecoin, so that they keep all the kind of consumer protections and stuff. So maybe it won't change as much as people think.
Appreciate both your answers. The great American philosopher Yogi Berra said, predictions are hard, especially about the future. So thank you for those forecasts. I'll yield back the rest of my time.
Thank you. Commissioner Stivers.
Thank you. Thank you both for your testimonies today. I'd like to turn to cryptocurrency and stablecoin in Hong Kong in particular. And Mr. Chorzempa, you talked about this both in your written and oral testimony. And I'm a little bit confused, and I'm hoping you can help me out on this. It's very clear that Hong Kong has positioned itself as a crypto and stablecoin hub, a gateway. They've been calling on more investors. They've been hosting all sorts of conferences. It's been a major priority for the Hong Kong government. So the question specifically that I would have, is Beijing using Hong Kong as a gateway to the international cryptocurrency and stablecoin markets, or are Hong Kong officials getting ahead of Beijing, especially considering that crypto is banned in mainland China? What's going on here?
I think the most dangerous thing for anyone in Hong Kong to do would be to try and get ahead of Beijing and get over their skis. So I don't think that that is likely, especially because of what's happened in Hong Kong, which I think this commission knows quite a bit about, and how policed that has been. I see that Beijing sees Hong Kong as a useful place for experimentation with things that they would not want to experiment with yet on the mainland. And the stablecoin regime is maybe the best example of that, where since 2021 or so, all cryptocurrency business is banned in China. At one point, they were dominant in Bitcoin mining. There was a ton of transactions, and they have effectively shut that out. Now, many Chinese people are still using stablecoins to get money out around capital controls. But my sense is that Beijing explicitly authorized as a way to hedge their all-in focus on CBDCs, seeing that there was an expansion at that time in stablecoin volumes that was enormous, and seeing this pressure maybe from the US. I mean, what if the US strategy worked and we'd continue to see rises in stablecoin volumes and it entrenches the US dollar around the world? That's a really bad scenario for Beijing, in which currently the US dollar share of stablecoins is like 98%. Which is much higher than its share in other markets. So I think they authorized it, but then they always want these to be under controlled conditions and not get too far. And my sense of what happened is that the fintech companies got too excited. For a long time, they haven't really been able to do anything exciting. Since Jack Ma made his speech and the crackdown happened, they've been really in a tight box, and they saw this Hong Kong regime as a way to really build out the international networks that they haven't been able to create up until this point. But then their stock prices started rocketing up, and they started talking about all these new things they were going to build, and Beijing's like, wait a second, this is a limited pilot program, and they didn't want to get to a situation where this gets so big that trying to contain it again leads to a big stock market decline and dashing of expectations and all that. So there was a miscalculation, I think, on the side not of the Hong Kong authorities, but of the Chinese firms who wanted to get those licenses as a way to lobby Beijing and say, hey, the US is going to eat our lunch if we don't do this. And that was an active debate in Beijing with very influential people pushing for stablecoins there, but they ended up losing in this case, in part because the other side got overly ambitious.
So trying to break that down, so would you describe Beijing's attitude or policy on cryptocurrency in Hong Kong as an experiment that they're allowing to move forward, or is it something that they're actively trying to resist?
An experiment that they want to move forward, but in a very careful, limited box. So now they're saying stablecoins are fine, but it's a joint venture with Standard Chartered on one side and HSBC on the other, kind of stalwarts that they know and understand, and who have banking regulators breathing down their necks all the time, making sure they don't make what China has called irresponsible statements about really expanding. And we just don't hear about the regime as much anymore. We don't see that these big volumes are occurring. Nobody expects that they're going to be a major competitor with Circle or Tether. Instead, it's probably going to be some kind of back-end infrastructure thing that doesn't end up looking that exciting.
Okay, Mr. Petry, you look like you have some thoughts there.
Yes, thank you. I would agree that, Hong Kong is basically Beijing's sandbox when it comes to this. And I think there was a rethinking in Beijing in recent years that Hong Kong is still needed as a financial center, as an international financial center, one that Shanghai can't be at the moment. So its kind of role was reinstated. There were a couple of policy statements in recent years around that as well. And we can see it in commodity markets as well. The Hong Kong Exchange bought the London Metals Exchange, which the Shanghai Exchange Futures Exchange could have never done, right? Hong Kong did it. And I think we see that actually extending China's influence indirectly. It's not a kind of state-owned exchange, the Hong Kong Exchange, but still there is some influence, and we see LME actually becoming more Chinese in the process.
Okay, thank you.
Commissioner Keikin.
Thank you very much. As I was listening to you guys, I was reminded of a speech that then Secretary Jack Lew gave at one of the think tanks around town about if we continued to use sanctions as the primary sort of weapon, in conflicts, that we were going to eventually sort of find the dollar becoming marginalized in international markets, and I think you've largely confirmed that, unless I've misheard you. Is that correct? You got to say it in the speaker so we have it for the record.
Yes.
The microphone, thank you.
Yes.
Thank you. Nodding works, but not if anyone isn't watching. So traders need to post margin to collateralize their trades. What are the implications of Beijing allowing foreign traders to post U.S. dollar collateral for the internationalization of Chinese benchmarks and exchanges? Go ahead, both of you. Sorry.
I think, from Beijing's side, that's maybe quite a smart move because it enables international investors to access these markets more easily because they always have US dollar. You can post these as margins, but the contract is still denominated in RMB. So if they would use it for kind of benchmarking, this would be RMB nominated, but the trade is done or enabled through dollars. So from Beijing, I think it's a way to ease global investors into their markets.
I agree with Johannes, and one of the things we've seen is, in China's financial markets in general, Chinese foreign banks are vanishingly small as a portion of China's markets. And one of the reasons for that is that they've done the opposite of what you just described, where they say, you have to have local capital. We're not going to count your international capital against the lending that you can do in China, and that has restrained the ability of international banks to compete. But in this case, they want the opposite. Instead of restraining the ability of international banks to compete in their jurisdiction, they're trying to pull them in, and recognizing kind of what I was saying at the very beginning about of my testimony about the fact that getting your hold of all this renminbi creates a lot of frictions right now. One way to get around that is exactly what you described.
That's very helpful. I was just trying to think of something clever to say to follow on Commissioner Miller's comment about money balls, but I don't have anything on that front. Is there a coherent allied strategy that we can think about here on commodity market architecture, or are we letting this one sort of go by default? I'm just thinking, the Australians use Chinese benchmarks on iron ore. We're seeing the Middle East start using Chinese benchmarks on oil. You sort of just talked about some of the things that other international banks are doing. Is there any way we sort of find a way with either the Europeans, the Indians, the Japanese, the Koreans to sort of think about an allied strategy here, or is that sort of wishful thinking?
I think that, this is definitely something that the US could pursue, but I don't think it is that important because these are not the countries that produce these commodities. Australia, yes, but let's say Korea and Japan, not, for instance, or Europe, neither. So it's rather kind of finding new allies, re-engaging countries that actually produce these commodities in Africa and Latin America, Indonesia, for instance, really engaging more with these countries where we have the physical side of the commodity production, which then kind of gets linked up with the financial side.
The link I would draw is in a little bit different category, which is thinking about the critical minerals issue, for example, and how many of these are just not only traded in Beijing, but their prices are entirely determined by Beijing's decision of how much supply and who gets what supply. And we're engaged in all these discussions with allies. And so the pricing element of those, whether we have, offload agreements where, we're effectively setting the price not in financial markets, but politically amongst countries and market participants, that kind of thing is where I would focus the allied discussions so that we can have something that provides enough price stability to get private capital into these markets and develop this alternative capacity with the recognition that we're going to be paying way above the market price in Beijing, and someone has to pay for that to get the resilience that we hope so that China can't keep using this as a choke point on us.
Do you think that the countries, Mr. Petry, that you talked about, the African countries, Latin American countries, is this something that you assess they'd be open to, or something they would just sort of dismiss out of hand saying, we've seen this play before?
I think there could be openness towards that for sure. What we see is that there is hesitancy to adopt these Chinese benchmarks at this point, right? So there is definitely room to pull back these actors, basically, or kind of put them into the US fold, if you will.
Anything you want to add there or no? Thank you.
Great, thank you. We're going to do a quick second round. I have a follow-up question. Commissioner Price and Stivers, anybody else, let me know. Dr. Petry would like to have two questions for you. One, you mentioned how Shanghai is expanding its warehousing and for physical markets. What are the implications of that?
So the implications for that is that it's much easier to actually receive commodity shipments that are kind of based on that price, right? So it's not just kind of a purely financial transaction, but actually we have a shipment or delivery of commodities to a specific location, which makes it, without that, it's very difficult to use this as a reference price. I mean, it's a financial price, but without actually having it delivered somewhere, you can't really link it to physical trade. And expanding warehouses is exactly that link between physical trading and financial contract that is needed for a reference price.
And then what does that mean down the road? Or what could that mean down the road?
It could mean that these prices are used more often in actual physical delivery, which means that Chinese benchmarks become more important.
Thank you. And then you also mentioned that the LME is becoming more Chinese. Can you unpack that statement?
Yes, so I think since the LME was bought by the Hong Kong Exchange in 2012, it used to have no Chinese member. Now it has 6. You can use RMB to collect as a margin for all your trades on the LME. There's mini contracts that are RMB denominated to kind of capture kind of Asian, or to enable trading in RMB, if you will. And there's discussions also about using Shefi prices as a benchmark for LME trading, which haven't materialized yet. And the LME opened its first warehouses in Hong Kong, making delivery to China easier. So all of these kind of elements, again, connect the physical trading with the financial side.
Thank you. Commissioner Price?
Thank you. Mr. Chorzempa, this is to you, but Dr. Petry, feel free to chime in as well. You have a line that says, or you talk about shocks that can change the status quo and reference the conflict in Iran with Iran as an example. In that regard, what are you watching day to day most carefully now with what's going on in the Middle East?
One side is U.S. sanctions policy that we, loosened to allow some of the pressures on global markets that are negatively affecting the economies of the U.S. and its allies. But then, just flip them back. So there's this inconsistency in policy, which creates challenges. And then really focusing on, the toll issue was potentially important for a period of time because you could have imagined that out of this conflict, Iran might not let go of its ability to potentially interdict ships going through this crucially important corridor. And we were seeing reporting that at one point that they were accepting payment only in renminbi or Bitcoin. And then we saw after that there was other reporting that maybe it was only in crypto. So that you're really watching China's actions here is important. If we rewind back to the Russia-Ukraine issue, what we saw is that Chinese firms really did not want to get themselves on the sanctions list. So once we started threatening secondary sanctions, Chinese banks pulled back massively, and then you'd see Russian banks complaining bitterly about all the documents that were required from the Chinese counterpart to facilitate a transaction to make sure it would have nothing in connection with a sanctions violation, no sanctioned individuals in Russia, or export-controlled commodities or technology or anything like that. That shows the continued power of U.S. sanctions. So watching, is the renminbi really going to be used in a major way to help the Iranian regime? It's possible, but if we threaten secondary sanctions on them, maybe Iran doesn't want that because they're concerned that the Chinese, threatened by the U.S., would pull back, and then that leaves them with Bitcoin. If in stablecoins were not included in that because the issuers often have U.S. law enforcement embedded in them to make sure that they can freeze wallets that are used in sanctions busting transactions. So that's really a live situation that's worth watching. Of course, now we've blockaded the entire strait, so I'm not sure how much the Iranians are making in Bitcoin or in yuan to get through their part of it.
Thanks. Anything you'd like to add? Okay, thank you.
Commissioner Stivers.
Mr. Petry, you talked a lot in your testimony about how the Chinese government is trying to internationalize their futures exchanges to entice greater global participation from U.S. investors, entities, individuals. Are there steps the U.S. government should be taking to try to disincentivize that participation in those markets for U.S., again, investors or individuals or companies?
I think it's a difficult question. In the short term, this might have a positive impact for the US, but I think in the long term, it would further undermine the kind of foundations of the US financial system, right? I mean, we talked a lot about one of the issues why China is struggling to actually receive more momentum here is because it has a state-controlled system where the state intervenes more into markets. If the US does the same, the difference becomes smaller between the two systems. And we see that the more we have kind of sanctions or weaponization of the dollar, be it kind of perceived or actual, we see Beijing's RMB dollarization picking up, becoming more strong here. So I do think that disincentivizing US investors from participating in these markets would backfire in the end.
Okay, thanks. I just want to quickly go back to sanctions. Mr. Chorzempa, I do agree with your testimony that sanctions should be used carefully and to avoid overreach. But too often that's used as an excuse to not go after some abhorrent individuals committing human rights abuses, entities that are violating U.S. national security, some very important things. And sanctions, are an alternative to conflict and war, and it is a powerful tool that the United States and others, obviously our allies and partners, should try to use in conjunction, but that's not often how it works. Other countries are not in the same position as the U.S. in terms of power to resist the Chinese government in many cases. And so I want you to be very clear on your position here. I get that you would oppose, it sounds to me, and correct me if I'm wrong, that you would oppose the use of financial sanctions on allies and partners. You mentioned the International Criminal Court. But the use of targeted sanctions on entities and individuals in adversarial countries, China, Iran, Russia, those are important, and they also, do you really believe that those sanctions really diminish the U.S. dollar system, especially when these countries are all trying to avoid that system and work against that, already?
I tend to support use of sanctions in those cases when we have a really good case. And one of the things that I think is very positive about our sanctions system is that it has a good judicial review system compared to our export control system. So some of my positions in the past have been that sometimes we use these things without a good evidentiary basis, and then that also then undermines our case to allies to say you should join us in putting the same Chinese firm on the blacklist. If we have a really rock solid case that there's a negative impact to U.S. national security, we should do it. Where the real risk of overreach comes is not in a specific small targeted sanction, but in something that has massive spillovers. So if we think about Huawei as an example, I think there are probably few fans of Huawei in this room, but it's important to note that they're on every possible export control list pretty much, but they're not on the SDN sanctions list. And part of the reason for that is that they're embedded into telecommunications networks all around the world, and our allies would then suddenly have to make a choice between continuing to pay for maintenance of their telecoms network or complying with U.S. sanctions. That's the kind of position that would potentially be very negative for the use of the dollar and impose significant negative diplomatic costs. It would probably maybe kill the company, but maybe not, because there are places that would then have strong incentives to avoid U.S. sanctions. And Chinese banks are another example. We're thinking about the kind of really bad scenarios that could happen regarding Taiwan. Putting massive crushing sanctions on major Chinese financial institutions would have significant negative blowbacks for the global system. That doesn't mean we shouldn't do it, but it means we have to be very clear-eyed about the costs that would be imposed on ourselves from doing that, even in the absence of Chinese retaliatory actions.
Great, I appreciate that clarification.
Commissioner Keikin.
I haven't heard either of you guys offer any views on just crypto in general. I don't really have a specific question here, but as I'm listening to you guys, one of the things we just haven't talked about is sort of this just decentralization movement and whether that creates new dynamics, changes any of the sort of assessments that you're making. I mean, I think crypto's here to stay, from what I can tell, and it does have a real sanction evasions quality to it. It can also just change the dynamics of some of these things that are hard now, just because you can do it over the blockchain. Just give me your sort of 15 or 30 seconds each, however much time you want to take, on how we should, as an overlay to the conversation we've had today, apply crypto to the conversation.
I think when it comes to crypto, there's an interesting, here again we have this comparison between a more state-controlled system and a more market-based system, right? I mean, China banned crypto for a reason and actually is one of the front runners when it comes to central bank digital currencies for exactly that reason. Because it kind of, if you have a system that encourages or that demands state control of the financial sector, a cryptocurrency is what you don't want to have. So I think that is going to be one of the defining features of kind of financial systems, is that we will have this kind of split between stablecoins, crypto, and CBDC systems, because one lends itself more to state control than the other.
Yeah, so first is China is not in the crypto race at all. They've completely banned it. They've given up their, they had so much influence over the system when they had controlled much of Bitcoin mining, but they've given up on that because they're afraid of any contagion to their system. Another is thinking about this, there's a kind of double-edged sword with it, in that many individuals and countries have gained significant financial freedom, especially from financial repression, because of access to crypto, but that also allows officials to take bribes in crypto that don't show up in any of their bank accounts. It's much easier for criminals and ransomware operators to just get around any restrictions because they get the money and then they can move it into a mixer. So it's a massive challenge for U.S. sanctions. And the most important thing I would watch going forward is if crypto adoption continues to expand, and especially stablecoin adoption continues to expand, we'll have less need for on and off ramps. Why that matters is if you need to go to a U.S. financial institution and buy USDC or Tether, and then if someone who is the recipient to actually use that needs to sell that to someone and then get their domestic currency, that is a space that we can regulate. And that is a space that has to do a compliance KYC check to make sure we're not doing money laundering or terrorism finance. If we have a massive crypto economy that just circulates amongst itself and no one needs to go on and off into fiat money, we lose the main jurisdictional hook, and we won't be able to see those transactions, and we won't be able to control those transactions. And one last thing on this is I think really needs to be understood is currently US dollar is used for a lot of criminal stuff around the world. And to some extent, that's because that's cash. And the flip side of that negative bit is that that is a free money for the US Treasury, where the criminals all around the world who are moving, briefcases full of $100 bills, that's free money to the US. Now, if those criminals are instead doing stable coins, then it's not free to the US anymore. It's demand for treasuries, underlying demand, but that is, instead of giving free money to the US government, a free loan, the stablecoin issuer is making money, lending that money to the US Treasury. So a move from US dollar physical cash to US dollar stablecoins is a big loss, actually, to the US Treasury, and I think few people know that.
That's fascinating. So they've banned it. We're adopting it. The rest of the world, I assume, is somewhere in between. If I'm the Chinese, am I entering into this market to destabilize it and to sort of keep things, messy, for lack of a better description, or am I just going to sort of let things happen there?
In the crypto market, you mean? My sense is they just don't want to touch it. They think that it has too many risks to them, and so they don't want their financial. First, they started by banning financial institutions from touching it, and they were fine with individuals. And then they kind of discouraged individuals, made exchanges hard for people to get their hands on it. And then it was only the miners who had access to digital currency. And then they shut down the mining because they didn't want anyone in China to have an inflow of crypto that they could then use in peer-to-peer transactions, trading with individuals. If I'm a Chinese person, sell my apartment, I want to get my money out. Capital controls won't let me, but there's a Bitcoin miner over here who has lots of crypto and is happy to sell it to me in a one-on-one transaction with no exchange. That's a way to get money out, and they shut that off. So they want that ring fence really strong, but it still hasn't worked because people in China get access to it through VPNs. But my sense is they're not really participating in any direct way.
Yeah, my question was less about sort of internal to China, but how do the Chinese look at the market outside of China, the crypto market outside of China?
I think they expect it's going to collapse on its own accord, and they don't need to do anything about it. But the arguments against stablecoins in Beijing are, for example, the U.S. is going to really regret this, the whole Genius Act thing. They're going to regret the stablecoins. They're going to collapse, and then they're going to have to figure out whether to bail them out and all that, and it's going to be all a big negative thing. And then we're going to be stepping in with our state-backed, super stable thing, and the world will go around us. So I don't think they feel they need to intervene in it at all.
All right. Thank you both for your testimony. Much appreciated. We will take a short break and reconvene at 11:05 for the second panel.
Ooh, nice. Our next panel will use case studies in base metals and critical minerals, agricultural and energy assets, or to assess China's pricing power in key commodity markets and its success in developing domestic alternatives to Western benchmark prices. We'll start with Ms. Suzanne Stroud, founder of Noble Agriculture. Ms. Stroud will discuss how signals from U.S. and Chinese futures markets impact physical production, trade, and stockpiling of agricultural products, and what China's strategic investment in Brazil's supply chains mean for U.S. agricultural market share. Next, we'll hear from Dr. Ian Lange, professor of economics and business at the Colorado School of Mines. Dr. Lange will examine how China's dominance in processing gives it significant pricing power over critical minerals, and how futures market participants are responding to growing trade in these minerals. Finally, we'll hear from Ms. Michelle Brouhard, Head of Policy and Geopolitical Risk at Kpler. Ms. Brouhard will survey how regional differences in crude oil trade have contributed to the uptake in China's oil futures contract. Thank you all very much for being here. The commission is looking forward to your testimony. And that, we'll get started. Ms. Stroud.
Testify today. My name is Susan Stroud. I'm founder and CEO of Noble Agriculture, an independent market intelligence firm focused on grains, oilseeds, and biofuels. Prior to launching Noble, I spent 15 years in commercial grain markets in the St. Louis region, working across logistics, freight basis, and export flows. I want to start with one simple point. The United States is not losing ground in global agriculture because of weak demand. We're losing ground because that demand is increasingly being met by competing suppliers, particularly Brazil. China sits at the center of that shift. China is the world's largest commodity buyer and the single most important export market for U.S. agriculture. For soybeans alone, roughly half of U.S. exports and about a quarter of total demand depend on China. That's not a customer that we can easily replace. At the same time, China is actively working to reshape how global commodity markets function, not just through trade, but through pricing, infrastructure, and financial systems. Today, I will focus on 3 points. First, how China's role in commodity markets is evolving. Second, how global trade flows are structurally shifting away from the United States. And third, what it means for U.S. policy. China's development of domestic commodity futures markets is often framed as a direct challenge to Chicago Board of Trade. In reality, it's more nuanced than that. China's markets, particularly on the Dalian Commodity Exchange, are large, liquid, and increasingly influential. They reflect Chinese domestic conditions and often act as a leading indicator of demand. But they have not replaced Chicago as the global benchmark. Global agricultural trade is still priced in US dollars, and exporters, including the United States, Brazil, and Argentina, continue to rely on Chicago for price discovery and hedging. What we have today is a two-market system. China is hedging domestically while the rest of the world hedges in Chicago. And the two are connected, but they're not interchangeable. Where this becomes more complicated is transparency. China's market data, particularly around reserves and stocks, is opaque by design. That creates information gaps that make it harder for U.S. producers and commercial participants to interpret demand. At times, China can step into the market aggressively, and at other times it can disappear entirely, drawing from internal reserves without signaling that shift to the rest of the world. That lack of visibility creates volatility and weakens the reliability of market signals. But the more important shift is not happening in futures markets. It's happening in physical trade flows. Over the past 2 decades, Brazil has emerged as the dominant supplier to China. Since 2000, Brazil has accounted for roughly half of global soybean acreage growth. Today, it exports more than twice as many soybeans as the United States. Since the first trade war in 2018, Brazil has added more than 30 million acres of soybean production and captured the majority of global supply growth. The result is a structural shift. The United States is no longer the primary supplier to China. It is increasingly a residual supplier, filling demand only after South American supplies are exhausted. That shift is reinforced by policy, infrastructure, and investment. China has invested heavily in South American logistics, ports, and supply chains, giving it more control over the timing, flow, and sourcing of commodities. At the same time, U.S. competitiveness has been constrained by infrastructure challenges, particularly on the inland waterway system, which directly impacts export costs and reliability here in the U.S. And layered on top of that is policy risk. Every period of trade disruption accelerates the shift. China adapts, it finds alternative suppliers, and those changes are not easily reversed. So what does this mean for U.S. policy? In my written testimony, I outline several recommendations, but I want to highlight 4. First, prioritize trade stability. The most damaging outcome for U.S. agriculture is not China's futures markets. It is sustained trade disruption that permanently redirects demand to competitors like Brazil. Second, demand greater transparency. China's lack of market transparency creates real disadvantages for U.S. producers. Market access should be tied to clear reporting around reserves, stocks, and trade activity. Third, invest in U.S. export infrastructure. The the Mississippi River system remains the most efficient exporter in the world when it works. Modernizing locks, dams, and waterway infrastructure is not optional. It's critical to maintaining global competitiveness. And fourth, strengthen U.S. market intelligence. We are operating with less visibility into Chinese markets than they have into global supply chain. That gap needs to be closed. And I will conclude with this. China is both our most important customer and strategic actor working to reduce its dependence on U.S. supply. Those two realities coexist. The question is not whether China will change the system, it already is. The question is whether U.S. policy will respond in a way that preserves our role in it. This is about whether the U.S. remains competitive in the world's largest agricultural market. Thank you, and I look forward to your questions.
Thank you so much. Ms. Brouhard.
Hi. Thank you for the opportunity to testify today. My name is Michelle Brouhard. I serve as the head of policy and geopolitical risk at Kpler, where we provide commodity intelligence through satellite monitoring of storage facilities, vessel tracking across global shipping lanes, and data analysis of physical commodity flows. Before I joined Kpler, I spent 25 years trading commodities on Wall Street. That combination, a career of a trading desk and daily visibility into the physical market, is the lens through which I wrote my brief before the committee today, and is the lens for which I offer my testimony. This panel is inquiring about China's efforts to promote benchmark alternatives. What began as a domestic hedging mechanism and a way for Chinese state-owned enterprises and refiners to manage commodity price exposure in their own currency has evolved into something with broader implications. Beijing built a market structure that now gives countries a functional pathway to conduct commodity trade outside the dollar system. And some are using that pathway to circumvent sanctions. But I want to be clear about something that often gets lost in the conversation. China's commodity exchange has serious structural problems that stand between where it is today and any credible claim to benchmark status. First, let me start with what a benchmark actually does, because I think it gets lost in the geopolitical discussions. Benchmarks organize markets. They determine how prices are calculated, how risks are hedged, and which currencies and which financial infrastructure sit at the center of global transactions. When a refiner in South Korea buys a cargo of Iraqi Basra Light, the price they pay is referenced to a benchmark. When a trading house in Singapore hedges that cargo, they hedge it on an exchange. For the last 50 years, those benchmarks have been Western exchanges dominated in dollars and clearing through U.S. financial infrastructure. In 2016, China's state-run Economic Daily wrote that developing domestic commodity future market was essential in giving China more influence over how commodity prices are discovered and referenced globally. Now commodity prices are ultimately set in supply and demand, and which should be controlled by a market. But who runs the exchange, in whose currency contracts are settled, and through whose financial infrastructure traders are cleared is determined by whoever builds and operates the market infrastructure. The Shanghai International Energy Exchange, or the INE, was established in March of 2018. When it launched, many Western traders, including myself, expected it to be dominated by retail speculation, prone to volatility, and unlikely to gain serious international traction. That proved largely incorrect. Less than 10 years later, the INE is now the world's third largest crude oil futures market. Overseas traders from 31 countries account for more than 30% of daily trading volume and open interest. BP, Shell, and Mercuria registered on the exchange from day one. Shell signed a forward agreement indexing the INE reference point on its very first day of trading. The design of the crude oil contract reflects careful thinking about where to compete. The INE's underlining crude is medium sour. It was deliberately chosen to serve Asian refinery configurations to avoid direct competition with the light sweet grades underpinning Brent and WTI. Physical delivery settles into bonded warehouses along China's coastline. China is actively filling a gap that is missing in the marketplace. Medium sour crude constitutes approximately 44% of global supply and had no dedicated future benchmark before the INE existed. Asia now consumes more oil than North America and Europe combined, yet Asian buyers historically price their purchases against the North Sea basket or West Texas pipeline contract and paid what literature calls an Asian premium. As a result, the INE addresses the structural market need that was unmet. I want to be clear about that because the committee should understand that Beijing did not manufacture this opportunity. It identified a real gap and it moved to fill it. The INE is not replacing Brent or WTI. Together, those two cleared over 400 million lots in 2023. The INE cleared 50 million. When a trader in New York checks oil prices at 3 a.m., they check NYMEX or ICE. They don't check Shanghai. Shanghai watches London and New York, not the other way around. There are 5 structural reasons for this, and I've documented them all in my brief. The most significant is the daily price cap. The reason why the benchmark is the INE benchmark is not going to work very well. Sorry, I somehow missed it in here. The most significant is the daily price cap of plus or minus 4%, borrowed directly from China's equity market circuit breaker framework. In April 2020, when WTI futures settled at negative 37.63, INE prices stayed within their band, decoupling from physical market reality at precisely the moment when hedging protection was most needed. A hedging instrument that fails in a crisis will not get used as a primary risk management tool. Capital controls are the second obstacle. Foreign participants cannot freely repatriate renminbi. A firm hedging buzzer light on the INE is simultaneously managing commodity risk, RMB USD exchange rate risk, and currency repatriation risk. On NYMEX or ICE, they manage one. The QFI channels introduced in 2022 reduced friction on market entry but left repatriation constraint entirely intact. The 3 remaining obstacles, opacity, regulatory risk, and a still retail-heavy participant base compound the mixture. China does not publish strategic petroleum reserve levels. Commercial inventory levels are unreliable and infrequently updated. At Kpler, we partially fill through that gap using satellite-observed inventory of floating roof storage, but we can't observe underground storage. Every trader pricing against a global benchmark must incorporate an unknown variable that Beijing controls unilaterally. Here's the analytical point I want this committee to absorb. The INE does not need to solve these problems to be consequential. It needs to be a viable, operational alternative when geopolitics make one necessary, such as sanctions. Before the INE launched in 2018, renminbi accounted for roughly 10% of Chinese cross-border trade settlements. By the fourth quarter of 2024, that figure had reached 40%. Russia's post-2022 pivot to the yuan settlement for China-bound oil exports has been the petro-yuan's most significant proof of concept. And here's the part that should give the committee pause. The shift was not driven by the INE's quality as the market. It was driven by U.S. sanctions policy. Every application of dollar clearing infrastructure as foreign policy instrument generates incremental demand for dollar alternatives among countries that have no ideological preference for the petro yuan, but a practical interest in managing sanction exposure. I'll leave it here because my time is running out, but I put some policy recommendations in the brief, and I look forward to your questions.
Thank you so much. Dr. Lange?
Members of the Commission, thank you for the opportunity to testify today on China's ambitions on commodity market derivatives and the future of exchanges for critical global commodity markets. My name is Ian Lange. I am a professor of economics and business at the Colorado School of Mines, where I'm also the Viola Coulter Chair of Mineral Economics. Colorado School of Mines is the world's leading university on minerals and mining engineering, and we are very proud to be the only U.S. institution that has a mineral economics program. Relevant to today's hearing, I have served as senior economist for energy on the Council of Economic Advisors in both Republican and Democratic administrations. I recently chaired a Commodity Futures Trading Commission subcommittee on critical mineral and derivative markets, and I'm currently involved in the Department of Energy's Critical Materials Innovation Hub. The testimony today reflects my personal view and focuses on how China's dominance in the midstream and processing sector and its growing influence over pricing and settlement mechanisms interact with the small, volatile, and rapidly evolving critical mineral markets, a dynamic central to the U.S. supply chain resilience and national security. To that point more specifically, most of the minerals that are traded on exchanges have a diverse set of companies and countries that are producing and refining that mineral. Sort of by definition, they're large markets. So think of things like copper, aluminum, iron ore, and precious metals, gold and silver. For the minerals that are commonly found on critical mineral lists, They are orders of magnitude smaller in market size. Again, think something like hundreds of millions of dollars in market size with a very concentrated supply chain. And obviously those conditions, extremely small market, sort of opaque, concentrated supply chain, are not something that lend themselves well to the conditions that facilitate the benefits from exchange trading. Think of things like price discovery, investment facilitation, and risk management. Numerous reports have shown that the United States mines, meaning pulls out of the ground, a large amount of many of the critical minerals that we are interested in. However, they're never separated from the overburden or dirt that occurs when you're, say, trying to move zinc to a zinc smelter. My colleague Elizabeth Hawley testified to this fact at an earlier hearing today. And this just sort of has revealed to me that the problem is primarily economics, in that we need to figure out a way to make it worth these firms' while to basically separate those products out. I would also like to emphasize that the information needed for many of these smaller market minerals to facilitate a properly functioning traded product is available. However, it's generally in the hands of a few, and they do their best to keep that information opaque. There's obviously mineral traders for many small market minerals, and they know the market for those minerals. They understand well where sources of supply might be and who might be demanding them at what price. And it's often it's this information that needs to be brought out for many to understand in hopes that those critical mineral markets facilitate investment and encourage price transparency. Before I get to my recommendations, just one word of caution. Pushing minerals towards exchanges, critical minerals that we deem important today towards exchanges, and the benefits that we believe those exchanges might provide can backfire in that many minerals, they provide some service within a consumer or defense product, but that service can be provided by other minerals, or that product through technical innovation might no longer be considered critical or useful. And there's examples of that I highlighted in my testimony. So given all of this, I have a couple of recommendations. When I see subsidy schemes, I often argue that they should focus on what might be like structured price partnerships rather than capital investment incentives. Maybe put another way, they need to be operational. Due to the pricing power that China commands, a lot of times capital support that has been given has not allowed these projects to move forward, and instead we have a really nice, shiny piece of dirt. Capital subsidies have led to basically a lot of empty buildings and some well-studied dirt rather than domestic supply chains. Perhaps to focus on, or to bring back something that was mentioned earlier, the great American philosopher Bill Parcells would say, the best ability is availability. And so from a mineral standpoint, I find that true. Having some minerals available is super important. We can think of either like advanced market commitments, we can think of contract for differences, or we can think of some other price floor as a way to spur actual production. Lastly, lack of demand for US produced critical minerals is generally a strong hindrance. You think about demand pull as opposed to, say, supply push, has been a big problem. And something needs to be done to encourage demand for US-based critical minerals. Whether this is in the consumer or defense products, the downstream industry tends to be very price sensitive, or to some extent maybe not even know what they're producing or what they're using, in their product. Say it's their supplier who buys it, and they don't even understand that they use it. So things like the Defense Federal Acquisition Regulation System rules that are coming out for rare earth magnets, tungsten and tantalum, these are set to go in effect July 1st, 2027, can be a useful tool there. So any policies to support that enforcement or encourage compliance, I believe will be very helpful to encouraging domestic or allied mineral production. Thank you. Look forward to your questions.
Thank you, Doctor. I think as the co-chairs, we're going to start questions again, and then we'll go through the commission. Doctor, I'll actually keep it with you. Lithium contract in China now appears to be the de facto in setting the prices, 15 times larger than Chicago. Did America lose the price-setting ability for lithium? And if so, how is that going to apply to some of these other rare earths? And what should we be doing about it?
I was like, one of the things that was also mentioned earlier was just, are we, interested in a fossil fuel-based economy relative to minerals and electricity-based economy? So I think some of the answers there are relevant to, or can answer the question of whether we should do something about it. But I mean, in general, for almost every mineral market, there's a small mineral market. Let's say lithium is not quite a copper yet, but relatively small. It's production, maybe somewhere else around the world. In this case, Australia is a large producer, but all the refining and processing is in China. So in some sense, it has to, like the pricing or the movement has to be mostly to China. Additionally, where a lot of the downstream products are made is in China, and so it's not surprising that a lot of that the pricing moved there. I mean, it would certainly, to the extent that the U.S. builds out a domestic battery manufacturing industry or sector, right, that could help move some of the pricing back. But in general, like I say, it wasn't a surprise that it moved over to China, and it seems like it's going to be hard to get it back. Given the use of batteries, we'll say, in the economy relative to other forms of energy. Thank you.
Ms. Brouhard, you recommended, we didn't get to your recommendation, so I'm going to help get to one of them at least. A Petro-Yuan monitoring office within Treasury. Is that right?
Well, that's right. I tried to be creative.
If that office existed today and it was briefing Congress, what do you expect the results of that briefing to be? What would they be saying? Especially related to the global oil settlement and RMB denominations, and what's the 5-year trajectory?
Well, the panel before me had briefly mentioned about the sanction, how commodities, specifically oil, has been traded on the INE because of the sanctions, policies by the U.S. government, as well as the toll booth that Iran had suggested they would set up. So as those ideas start to permeate through the marketplace, there starts to become more of a need to want to be able to monitor how commodities are going to start traded and transaction. So when I envision what the committee would look like, it would look something that would regulate the U.S. If you participate in trading in U.S. exchanges, or if you're a company that is a U.S. company and you trade on the INE and you have to trade in Petro-Yuan currency, it has to be registered with the CFTC, or it would have to be registered with the SEC, so that it could be monitored, so that you would be able to have more transparency into actually how much is actually being transacted over time. In 5 years, I don't know what that would look like. I assume it would look like at least there would be a lot more transparency than what we have now. All we have now to go off of is a lot of assumption-based modeling that goes into it. So you assume, okay, Russian oil is trading hands. It must be trading hands in Petro-Yuan. You kind of know the difference between the prices, and you can guess how many barrels are roughly being traded in it. So you can see roughly 20% of the oil market now is traded in yuan as opposed to US dollars.
Perfect. Thank you so much. Ms. Stroud. It's been suggested the BRICS grain exchange as potentially the most significant structural challenge to Western commodity pricing. Can you walk us through the mechanics of what that would look like? If Brazil, China, and Russia stand that exchange up, do they price in RMB? Is it a basket of various currencies? And what would the timeline be?
I think that it more becomes a situation where the U.S. is further squeezed out of various commodity markets. So, I mean, I think that some of that is already underway, even though there aren't necessarily, I think it's been a slow-moving process, and we're in the middle of it now as we watch and we see other developments happening between as relationships are strengthened between these other countries. As far as a way specifically to, I was trying to look here in my written testimony which number this is kind of going back to. As far as ways that the U.S. could, I think as we're pursuing trade negotiations and relationships with, or potentially sanctions or whatever it may be with Russia, and as we're moving forward with China, I think that these things have to be top of mind for the U.S. Trade Rep and USDA additionally as we move forward.
Perfect, thank you. With that, I'll hand it over.
Thank you. Ms. Stroud, pulling on that thread a little bit, the U.S. is being, you said the U.S. is being squeezed out of certain markets, and in your testimony, in your spoken testimony, you referenced soy. Are we seeing that in other agricultural markets? Are we seeing that in wheat as well? Is there potential for that in wheat? And then are there also risks with respect to specialty crops in addition to commodity crops?
Wheat is probably the, I believe I referenced the term wheatification, because wheat is maybe the original commodity where we saw this happen to the U.S., because the U.S. used to be a large exporter and an important global player in the wheat market. And we've quickly been overtaken, especially by Russian exports here over the course of the past decade or so. And so wheat has turned into a non-event for the U.S. Speaking of soybeans, particularly, Brazil accounts for 60% of global soybean exports. China accounts for 60% of global soybean imports. So that dynamic in itself is one that has really driven or helped push and evolve the China-Brazil relationship, and something that the U.S. has been squeezed out of because we're no longer competitive. But the biggest driving force there is that Brazil has had a tremendous amount of increase. They've had an average increase of 5% in soy planted area that's an annual increase on average for the past 25 years running. So that is the biggest driver there, because you have more production. By default, you have more bushels to export, and they're going to be cheaper to the world buyer. When we look at something like corn, on the other hand, the U.S. is the largest exporter of corn in the world, and we lost that. We were dethroned very briefly in 2022 because as Brazil expands its soy area, they come in behind it with a double crop. Generally, it's either cotton or it's corn. That's how Brazil has turned into one of the most important country in cotton. Is all because of that double cropping. They were heavy into corn for a while, and they still produce a lot of corn, but now they have a growing domestic corn ethanol program, and so that's giving us a little bit of breathing room. But getting back to your question on are there other commodities, soybeans will continue to remain the biggest focal point. I don't think that we will get ourselves into a position where we see something that's similar, because we are the largest producer of corn in the world. And, thankfully we have strong domestic biofuel programs that support that and will continue to support that.
Great, thank you. Dr. Lange, we'll turn to you, but anyone else on the panel should feel free to respond as well. Have we seen efforts to manipulate either spot prices through commodity trading or supply constraints, either actual supply constraints or fabricated supply constraints?
I'd say less on the constraint side, but certainly if you think of most mineral markets have, we'll say in the 2020s have the same pattern. They may run up a little bit, and then you have just a kind of a crash or oversupply, bringing the price down. Think of nickel, think of polysilicon. And my general understanding in the Chinese market, right, there are incentives to, say, open mines, find production. In this case, in nickel case, it's Indonesia. Say polysilicon, it would be in the Xinjiang region. And that overcapacity, of course, eventually crashes the price, and they say, oh man, that wasn't good. What can we do about that? And of course, generally nothing. I guess the other example would be what happened with cobalt, and then the Democratic Republic of Congo trying to limit cobalt concentrate exports. But the pattern seems to always be the same. And I don't, I sort of like this story that in a lot of ways, the goal isn't to sort of like get control and then run up the price. The goal is sort of to just get control and basically keep it, right? Keep selling the rest of the world these export products. So I'm less concerned about a scenario where the Chinese government says, okay, you guys, you're now hooked on cobalt, and now we're going to take it away, so the price skyrockets. I don't know, maybe that general idea is like they're not profit maximizers. You might think that they're output through maximizers, if I can use, again, like academic terms. Like their objective isn't profit maximization, it's more output maximization. And so I haven't seen any evidence that, they're, okay, now we're going to, jump up the price or artificially restrict supply.
Thank you. Anyone else?
Yeah, I just want to jump in really quickly. I think that markets like cobalt or lithium are easy to manipulate because the liquidity is very thin, but commodities like oil have become much more difficult to manipulate. I mean, we see manipulation perhaps in like shipping, which is also easy to manipulate because there's not a lot of liquidity there, or there's not a lot of supply and demand. So I just want to also mention that the difference in the liquidity will depend on the difference in the manipulation.
Great, thank you. Thank you.
I guess that means it's back to me. Commissioner Stivers.
Thanks. Let me start with Ms. Stroud. We know that the U.S. and Brazil are the main competitors for commodity exports to China. It sure seems that China is playing the two countries off against each other and has been for a long time. Is there space, or do you have any ideas for how perhaps the U.S. and Brazil can work together to have some sort of do we have mutual interests at all in this relationship? And is there a way to push back on China in a way that serves, again, both countries' interests?
I think that that would have been a very important question or concern to raise at the beginning of 2018, because the bigger concern at this point is that the first trade war with China effectively closed the door on U.S. growth and shoved all opportunity towards, or it only further accelerated Brazil's very rapid pace of expansion. As far as the two finding a way to work together, I think the biggest concern now is that China is so deeply rooted in Brazilian agriculture that it would almost become nearly impossible for the two to work together in some fashion. I think that ship has probably already sailed.
Okay, I appreciate that. Ms. Brouhard, I'd like to go to your excellent recommendations, and in particular, I believe your third one on the immediate legislative actions, where requiring disclosure of U.S. financial institutions who are on the INE. Can you talk? I asked a question to the earlier panel on if there are things or actions that the U.S. government can take to disincentivize U.S. institutions or investors from participating in China's domestic exchanges, and it would seem this would be a significant disincentive. This disclosure. I guess my question is, would it be a disincentive, and what would be the benefits of this disclosure for broader markets?
Well, there's a number of reasons. One, it would be probably disincentive, but it would also require transparency in the Chinese market, because once you need those disclosures, then you need to have more transparency in the Chinese market. And it's kind of an opaque market when it comes to all of the other markets. Like the US is by far the most transparent market, right? We publish every piece of data that there is, whereas China doesn't publish hardly anything. And if they do publish it, it's really hard to quantify whether or not it's true or not. So it would open up transparency, and it would make for a more transparent market, and transparent markets bring more efficiency in markets, which typically bring lower prices. So that's one thing. I think that the number one thing that would really help, though, when I mentioned this earlier, and I think I've mentioned it also in my written testimony, which is China, when they stepped in and started the INE with their crude oil benchmark, it filled a gap that was existing in the marketplace, which was a sour crude benchmark. And I think that it would be hard to move away from that because there is no sour crude benchmark. So what happens is if you trade a sour crude, it trades as a differential to the light sweet crude. So it trades as plus or minus, normally minus, one of the light sweet crudes. So if it's WTI minus $5 is how you get the Mars price, for example, the US Mars price, right? So there's no real sour crude benchmark, but all of Asia uses sour crudes. So if you're doing business in Asia, you really do need a sour crude benchmark. So I don't think it would disincentivize them from not being on there, but it would require China to bring transparency to it. I guess what I'm saying is that benchmark is needed. One of my other recommendations is get one of the other, like Japan, South Korea, Australia, to create a sour crude benchmark so that there is more transparency in the market. And there is another place where these producers that transact in sour crude and have consumers in sour crude are able to have a benchmark for that at a different exchange.
Okay. Thank you. Having worked on some of these disclosure requirements on other issues, industry usually screams holy hell whenever you try to do these sorts of things. I have a few more seconds left, but what would be the arguments from the different entities on these exchanges to disclose this information? Is it easy to disclose? Do they have this information?
No, it's not. It's not easy at all. And I think that China would push back on some of the disclosures that would be required, and it would probably force them off of the exchange unless China was willing to give the disclosure information to, let's say it's Total or something, and Total wants to do business in the US and in China, and in order to get those disclosures, they have to get information from China energy space, whether it's inventories or refinery runs or what kind of crude they're processing in their refineries, and then they have to bring it back to the US. China is not going to be willing to give that, and Total is going to have to make a decision, and they're probably going to choose the US market. So it would force them off, but begrudgingly, right?
Okay, great, thank you.
Commissioner Price.
Thank you, and thank you all for your testimony. Dr. Lange, I'm going to start with you because I need some remedial help. So you talk in your first recommendation, subsidy schemes should focus on operational support over capital investment incentives, and then a contract for differences or price floor can ensure actual production. Walk me through this. What should it be, and how would this work?
Yeah, I mean, I guess for most people would claim that this concern with critical minerals started around 2011 when China restricted some exports of rare earth into Japan, and the prices went up about 10,000% or something like that. And since then, it had been sort of a policy to say, hey, like, here's some money, go look at some of that dirt, or here's some money, build a refinery. And at least from where I sit, it's sort of like we're 15 years later and we're in the same place. We don't make any of these minerals that we had thought were critical or deemed critical or hope to have happen. And so, I mean, sort of thinking of something like, saying, a contract for difference would probably be like, okay, we understand that the Department of War will need X tons of tungsten, auction off, okay, for $10, who can give us that? For $12, who can give us that? And then what you're sort of doing is allowing firms to reveal their cost structure, reveal how much it's costing them to make it, and it sort of lets there be like an anchor customer, because generally, if you're going to start making a lot of these products, it's you have a mine that you want to run all the time. You don't want to sort of stop and start the mine. You have a smelter, again, you want to run all the time. You don't want to stop and start it. So in order to meet a certain, we'll say, quantity, again, you're probably going to build capacity that is not exactly equal to whatever, say, your contract is, and then you open up the possibility that other people could be there to say, oh yeah, I'd also buy that, right? Like, hey, if you were making some and you're here, I might buy that. Maybe another way to think of it is like a bit of a chicken and egg problem. Like nobody's out there saying I want it, so no one's saying I'll build it, and no one's out there saying I'll I'll build it, so no one's saying I want it. And we need a way to sort of break that, not through, again, characterizing more dirt or helping somebody, let's say, lay concrete and start to make a building, because essentially if they start along the capital subsidy line and you start building a building, say a refinery or a smelter, and in the meantime, nobody wants the product, right? You're why am I hurrying, right? I'll just stay, I'll stop, I'll wait until somebody's, looking for this thing. So I feel like if you can get some demand locked in, it starts to be a ball rolling downhill. So I don't know if that's clarifying, or maybe all my euphemisms made it worse.
No, I think it did work. Thank you. Lock-in demand works. Thank you. Ms. Stroud, you went through some of your recommendations, but you skipped the number 4 about creating a clear national security framework. Can you talk about that for a moment?
Sure. I think that given the fact that China, as my friends here to the left and right, who they've also testified that the Chinese market is very opaque, and so we sitting here in the U.S. have very, very few ideas with certainty what's going on in China as far as Can you excuse me for just one moment? I need to go to the restroom.
No problem. Thank you.
Sorry,
No
I'm
problem.
fighting a migraine.
Just
I'll be right
whenever you're ready. Thank you.
Okay. So, Ms. Brouhard, we've covered 2 of your excellent recommendations. Commissioner Stivers and Budovich asked particular questions. If you have an extra minute to talk about your favorite, if those weren't it, what would it be?
Well, my favorite, of course, is that there is another exchange that can be competitive against the Chinese exchange. And like I said, that sour benchmark exchange is actually really an important benchmark. I don't necessarily think it's going to be set in the U.S. or set in Europe, because the U.S. and Europe produce and, for the most part, refine light sweet crude oil, whereas in Asia, they produce and refine heavy sour crude oil. So it makes sense that it would exist in Asia. So that is my favorite. It also feels like, to me, the easiest, because the market needs it. You could get Japan or, Singapore has tried, and there is somewhat of a Dubai contract, which has obviously has had some problems today because of the war in Iran. So I think that that's probably my favorite one. My other favorite one is to, I like the disclosure one. I think that would force, but I think it would also cause a lot of pushback from the industry, but also the CFTC. So I think that the CFTC could also just require more regulation when it comes to dealing with companies that transact onto the Chinese exchange. Sorry, I didn't realize I just went over. Sorry about that.
That's okay. Thank you so much.
Commissioner Miller.
Thank you, and thank you both for your testimony. I thought they were excellent. I want to get back to the Petry yuan. I thought that, Ms. Brouhard, your testimony was very balanced in that it presented a dual story. On the one hand, you've got structural constraints limiting the ability of the Petry yuan to rise. On the other hand, in the recommendations, you see it enough of a concern to recommend that we establish a monitoring office in the U.S. Treasury Department. So I want to push you on this a little bit more. If we're going to assume that Petry yuan has anything to it, we have to be willing to assume that countries around the world will be willing to be paid in a currency they can't convert. A little bit hard to believe. And it's, to the extent you have the yuan as a payment currency, sure, it's trade with China, there's a sanctions issue. But if it's payment and settlement in yuan, but the ultimate commodity is denominated in dollars anyways, is this even a Petry yuan in any meaningful sense? So what I'd love for you to do is just walk us through why we should be concerned about a petro-yuan really in the first place. If there are these structural constraints, both that you listed, that I just mentioned, why should we care about any of this?
There are so many more structural constraints as well, right? Like the manipulation of the Chinese currency within the Chinese government, right? There are lots of constraints. Nobody wants that, whereas the dollar is just such a liquid asset. It has clear monitoring policies, right? Like it is, and the Fed has done a good job at balancing monetary policies. So I think that there are plenty of reasons to not want to go in that direction. But the reason to go in that direction is when you have no other options. So for example, Iran, for example, Russia, for example, Venezuela, right? If you have nothing else to transact in, transacting in something is better than nothing. And China, while a price taker, which is one of the reasons why they wanted to establish this exchange. Their idea of establishing an exchange because they didn't want to be a price taker and they wanted to be a price setter. Well, the exchange does not set the price, right? The market sets the price and the exchange is just where it transacts. So the INE being China being a price taker means that if you are a supplier, such as the Saudis, and you want to sell your oil into China, and they mandate that you sell it that you transact in yuan, then it will just happen that way, right? Because they'll have to. Now, the Saudis would have to convert it back to dollars if they possibly could, or they would have to somehow figure out another way. There could be an entire new microcosm that exists within the UN system, right? Right now, if you have UN, you probably can do business in Saudi, you can do business in the Middle East, you can do business in Iran, you can do business in China. But if you have dollars, you can also do business in all of those places. Plus, you can do business in Latin America. You can do business in Europe. You can do business. So I understand the constraints of it. It just feels like it's creeping a little bit more, and it has started to become. 5 years ago, it wasn't even a topic of conversation. And now it must be a conversation that I have with traders every day when we talk about it. And when the toll booth came, I wrote this long note about also if the transaction is in yuan, right, then you have more yuan in circulation inside of the world.
Okay. So essentially, it's a sanction story, and it is an issue if the dollar becomes increasingly toxic over time. More toxic.
Yes.
Yeah. Thank you. So, Dr. Lange, let me ask you a technical question. You talk about physical settlement versus cash settlement, and you say that physical is preferred. Why is that? I mean, if we were talking just gold, the issue might be a rehypothecation. Is that an issue here, or are there other concerns related to settlement?
No, I think you're right. It's not. How's it say? It's not crystal clear to me that physical settlement would lead to, say, some downstream investment or investment facilitation. But it sort of is a signal that the people around there, somebody's there to use these things. And I feel like, in the Western world, there's a lot of cash settlements, and it's a lot of sort of looking to what's happening in China for where it's actually being used. And so at least it's one, I guess you could say, suggestion or one hypothesis as to how there could be more production of these downstream products that we're really interested in, is sort of ensuring that there are those inputs available through physical settlement.
Vice Chair Keiken.
Thank you. I'm so glad you're back, Ms. Stroud, because I've been dying to say that when I named my consulting firm, no bull never came up in my mind. And so #respect on naming your firm. So I wasn't expecting to hear about Brazil today, Ms. Stroud. So what I'd love to actually hear you talk about is, so this is happening in Brazil now. Is there something that we should think about that's the next place?
That's a good question. I think the expansion will continue in Brazil. They have one of the largest amounts of available arable land in the world. So a combination of conversion of degraded pasture land and in the Brazilian Cerrado. So I don't think this is a situation where we see it slow down significantly. I do think that it will start to slow a bit, and it already has just because of economics. But I think that this is really where the focal point must be because there's no country in another situation like it.
That's helpful. Soybeans, when I was preparing for this hearing, I was not expecting to talk about soybeans. Is there a reason we shouldn't think about alternative crops? Just given this competition space, and whoever wants to answer, just pile on. Ms. Stroud, you're in the middle, so you get to go first.
So soybeans take front and center because that is our largest product by dollar trade with China every year. And soybeans are also front and center because China needs soybeans to import to crush so they can feed the protein-rich soybean meal to their hog herd, the largest hog herd in the world. As far as the U.S., soybeans are critically important to the U.S., and I'm not certain that I might have to excuse myself.
That's all right, Ms. Stroud. So the one thing I learned about the last time I was in was duckweed as a possible replacement for feedstock for hogs. Mr. Lange, can you talk about which other critical minerals could see the introduction of new future contracts and how China is pursuing these opportunities?
Yeah, we've had, certainly the battery minerals were big, we'll say, last 5 years or so. And so I would say you're probably looking at markets for, maybe like hardeners or alloys to steels and aluminum. So we could imagine seeing exchange-traded products for, we'll say, scandium to go with aluminum. Obviously, there's lots of talk about rare earths, but I see that market sort of being limited to expand a lot, and a number of the production coming online is sort of through contracts with the U.S. government already. So not really sure sure, there could be some value in making, say, neodymium, praseodymium, the rare earths that are in the magnets, exchange traded contract, but I think that's relatively limited given the activity that's already been there. So if anything, yeah, it would probably be something that alloys with materials like steel and aluminum as we look to produce more products, that can handle sort of the high temperature or what is needed to keep those things working.
That's helpful. One more question for you, Mr. Lange, and then I think I'm going to run out of time. There was the China Mineral Resources Group got created not long ago. One first question is how is iron ore how is that, if at all, affected iron ore pricing globally? And then the second thing, what are the consequences of diversification away from Platts and iron ore spot pricing toward competing indices?
Yeah, it's a good question. Iron ore is not iron ore is not usually my thing. It's not often listed as a critical mineral. Obviously, it has some defense applications, but yeah. So I don't have a good answer there. Obviously, China's a large producer of steel. They dump steel on the market, and of course, as a result, they would like cheap iron ore in order to be able to do that. And I think to the extent that either through some sort of anti-dumping provisions or through investments elsewhere to use more allied or domestic steel, we can sort of limit the impact of that, of those changes that you refer to.
Thank you.
Yeah.
Commissioner Hodges.
Thanks for being here today. The conversation on Brazil made me think back to 2018, 2019, when I was meeting with the government of Brazil and talking to them about competition on technology and trusted vendors. And they raised sort of this factor of sort of leverage related to soybeans and Brazil and commerce with China as a main obstacle impediment and a leverage point. It seems now, 6.5 years later, this same issue of soybeans is being leveraged against the United States with commodities. And so I think that should be as we're looking at the ecosystem of different leverage points the Chinese are using, is they're increasing, they're not decreasing. And Mr. Lange, my question for you today is, you talk about midstream and downstream impacts and intermediate chemicals. And your testimony specifically states the U.S. has a few midstream assets. And as we're looking at this ecosystem from the Commission's standpoint, making recommendations to Congress, we're looking at APIs, we're looking at other choke points. Are you concerned, based off of the data you've seen and your research, that these U.S. assets could be squeezed out by China? And what's the implications if those are squeezed out?
Yeah, I mean, there are definitely, right, there's 2 copper smelters, and one of the things that China's definitely doing is trying to build a bunch of copper smelters you might in some sense like take over the copper market, for lack of a better word, on the midstream side. Right now, it is still relatively diversified, and it's been well known, right, the net smelter returns at copper smelters have been negative for about 18 months. So you might argue like their strategy is working. And then we obviously have the other ones I can think of are like the zinc smelter in Tennessee, which there was just a big Department of War, Department of Commerce appropriation to. There's a platinum group smelter in Montana. And so I would say, I don't know that we need a lot more, but having, a couple more. And also, I've always thought, maybe like, for lack of a better word, those smelters, make sure they're using the whole buffalo. So as I mentioned in my testimony, right, a lot of the critical minerals are byproducts. They're there with the zinc, they're there with the platinum, they're there with the copper, and it would be easier to stand up something that's already there, right? So you take the platinum smelter in Montana, and you make sure it also recovers its nickel and cobalt, because again, you're already mining it, it's already coming up out of the ground, you already have a smelter operating, you don't have to build a whole new thing. And so ways to encourage, we'll just say, using everything, I think are winners and just biggest bang for the buck kind of way.
And one thing that jumped out at me that I didn't expect to see in your testimony was the reference to intermediates and chemicals. How relevant are those for what you're talking about? And sort of in the process of midstream to upstream.
Yeah, I've actually been asked that question a couple of times by other folk in industry, especially for I like to say, right, for things like rare earth or a lot of these, we're going to go from 0 to a big number, and so it's an infinite % increase. That might be hard to do for the input manufacturers, and so far I have not found that it's a huge concern of the people who are trying to go from 0 to infinite, or have an infinite % increase. But sorry.
Let me ask the question in a different way. Are you seeing any data to suggest that the Chinese are trying to sort of squeeze out these U.S. assets where there is sort of where they're taking chemicals and they're then refining it and building the products at the midstream level?
Yeah, a little bit, but yeah, I mean, I do feel like there's an understanding within the Western world or in the U.S., right, that we're going to need these intermediate goods like the chemicals or the leaching techniques, and I haven't found anybody to tell me we're really concerned. Everybody says we get what we need, it's on its way. Nobody's telling us we can't have it. So,
all right, thank you. And Ms. Stroud, from your ground level view, we were just having a conversation on sort of the shift in sort of leverage points over the last 6 or so years, related from Brazil as sort of squeezing Brazil on the soybean issue to sort of leveraging this against the United States in commodities. From your ground view level of sort of grain supply, chemical precursors, would you, in your opinion, think sort of the U.S. industry is aware of just how much the Chinese are increasingly having control of this market?
Yes, very much so. I mean, I think that it goes back to really it goes back to 2008 when we saw the massive boom in China, and that kind of caught the world by surprise, and we saw a tremendous super cycle begin in commodity markets, and a lot of that going back to China's tremendous growth, being the largest commodity importer in the world. Anything that's happening there has a direct impact on the rest of us.
Thank you. No further questions.
No texting and driving. Commissioner Brand.
Ms. Stroud, I'll just pick up on Riva's question. You had a recommendation about Chinese purchases of farmland in the U.S. Could you just talk us through that a little bit? What's the state of play at the moment? And tell us a little bit more about your recommendation for a more coherent and unified framework, please.
Yeah, you know, it kind of goes back to China's WH Group purchased Smithfield, largest pork company in the United States and one of the largest in the world. And, you know, you look at something like that, and then you look at the existing regulations or the way that I think we're seeing it at a state level start to crack down on who is okay with China owning farmland. And some of that goes back to, again, the WH Group and Smithfield. I do think, though, that there needs to be we have to put it under scrutiny. You know, we have Chinese companies that are very active in U.S. agriculture. COFCO is China's state grain trading entity who also has an international arm with a presence here in the U.S. I think they've started to divest some of those assets, but they're still very active in trading here in the U.S. And it also goes to, I mean, just for example, COFCO, their agreement, so anything that they're sourcing here in the U.S., that they are putting those bushels through a facility owned by a Japanese entity at the U.S. Gulf. So it becomes a little more complex.
Thank you. That's it for me.
I think we have one follow-up. Commissioner, co-chair.
Thank you. A couple of follow-up questions for the panel. We spend a lot of time focused on monopoly, but don't really talk about monopsony. And China really does have the capacity in a lot of areas to exercise monopsony power in addition to being the primary manufacturer of a lot of components. Dr. Lange, I see you nodding your head, so I will start with you, but welcome anybody else on the panel chiming in on that one.
Yeah, I mean, as you were brought that up, it brought to my mind, apologies, that generally with a monopsonist, what you want to do is you want to sort of restrict how much you buy in order to force the firms to drop the price. And again, that's sort of to the earlier discussion, like if the objective is profit maximization, that's what we'll say economic models suggest. But this is where I'm less worried about this because I'm not sure that that's China's objective, right? They're not trying to produce less electric vehicles or solar panels or batteries in order to get, say, Australia to get them a better price on the spodumene that they're selling, the lithium that they're selling. And so, yeah, it's a great question. And except as it came to my head, I'm guessing that's the broken link, as to why we just don't see the monopsony behavior that we might expect.
Thank you. Anyone else?
I do think that it's just important to remember that although a lot of this, I think a lot of China's actions can be perceived one way, but you also have to step back and remember that they are the largest commodity importer in the world. And so just by scale, it means that any purchasing decisions that they make have large impacts. So I talked a lot about soybeans and the impacts there, but then there are also situations where they can swoop in and buy large amounts somewhat unexpectedly of U.S. commodities or of different commodities. And it has extreme ramifications on the market when they buy those, or for instance, if they cancel or back out of those commitments as well.
Thank you. Ms. Brouhard, you mentioned shipping infrastructure as a key choke point. I imagine that is similar in the agricultural context as well. Can you talk through any recommendations you have with respect to shipping infrastructure and the choke points that might create?
Yeah, I think choke points tend to be on everybody's mind these days because there's currently one being strangled. Another choke point that has started to come into view is the Strait of Malacca, and I think that China's very concerned about that. We've just published a report on it yesterday, if anyone is interested in it, about how China has positioned their shipping boats or like some fishing boats around. So I can't help but think that the rules for shipping are about to be rewritten with what's happening right now in the Strait of Hormuz, and especially what happened in the Red Sea a couple years ago. We could see a rewriting of rules of shipping lanes. I even wonder if we're going to go back to a time where there will be some sort of like minimal toll that's paid as you cross through these straits. I know it's against international maritime law to have the toll, but just from a national security standpoint, I wonder if we'll start to see tolls so that ships know who's coming and going through the straits. So I think that the rules in 5 years will look really different than what they look like today.
Interesting, thank you. And then just noting the INE and its focus on sour crude. To your point, that is a lot of the production in Asia, but I don't think we can leave this hearing without saying it also happens to be the primary oil that comes out of Iran and Venezuela. And do you view that as not just kind of like a regional strategic play, but also that China, because they import so much from Iran and imported significant amounts of oil from Venezuela, that was also a strategic decision on their part?
No, because I think that we always look at China kind of like the boogeyman, but they're really opportunistic, right? So when they built their refineries, which have been over the last like 20 years or so, when they started building their refineries, sour crude was the cheapest crude on the market. So they built their refineries to process sour crude. And it was because, Venezuela crude is like really dirty and it's very difficult to process it. The United States also processes a significant amount of sour crude. So it's not that they created their benchmark for sour crude because that's like the crude of like, the menaces of the world, right? They created the benchmark because that's what their refineries consume. And our refineries in the US also consume a significant amount of sour crude. And people built those because sour crude was so cheap relative to the light sweet benchmarks and the light sweet crude. So now we have a large amount of refineries that consume sour crude because they're new refineries that were built in Asia, because those complex refineries were built to process the cheapest crude possible. And that gap that was between the light sweet crude and the sour crude has really narrowed significantly only because all of these new refineries that have been built are sour crude refineries, which is why that sour crude benchmark is so important.
Right, thank you.
Amazing. Well, on behalf of this commission, I'd like to thank you all for being here. We've had some great testimony. The testimony and the video can be found online. We're getting into the social media game. Mike Keiken's going to do some dances as well, if you'd like to find those. Follow us on Twitter. And then I'd like to note to end the commission's next hearing, Taking a Bigger Bite, BYTE. China's expanding strategy for data dominance will take place on Thursday, April 30th. And with that, we are adjourned.